Just wanted to check on the margin side. In addition to Sanar, were there any one-offs in the margin? And another question was on the Udaipur hospital that, we discontinued the partnership. So what was the reason behind that?
Yeah. So at the standalone level, we basically have expanded the margins. So even though the top line has grown 11 to 12%, the margins have grown in excess of 15%. So there has been a margin expansion, and there has not been any one-off. So you can expect such kind of operating leverage to play out as the revenue and occupancy grows in the standalone hospitals. With regards to the Udaipur franchisee, there was non-compliance at their end, and we were left with no choice but to cancel the agreement.
Right. And if I can just squeeze one more here, what was the reason for, earlier we said that Rajkot would be operational by Q1, and now we are saying Q2 FY25. So any reason for the delay?
No, there is no reason for the delay. It's just that we have started doing camps, and essentially the soft launch is already being done. So we are going to, the work has already begun, and we will have a full launch in Q2.
Okay. And any other franchisees, you are looking at, and we can see them getting added soon, anything like that on the cards?
So there are several in the pipeline, but unfortunately we are unable to share, as they are still, we are still in the discussion.
Okay. Thank you so much for the opportunity.
Thank you. The next question is from the line of Raja Kumar Vaidyanathan, who's an individual investor. Please go ahead.
Yeah. Good evening. Thanks for the opportunity, and congratulations for the good set of numbers. Sir, I have 2-3 questions. The first question is on the tax rate. So if I see the tax rate on standalone, it is about 34%, and console is about 50%. So that seems to be on the higher side. So just wanted to know what is driving this higher rate.
So basically, if you can see that in the tax level on the consolidated side, we have the two hits. Basically, the hit from the Sanar and our implant business, which is coming around that. And if you're talking about in terms of the interest and finance cost, what we have in Sanar, we have the finance cost of 168 lakhs for the quarter, and in the implant business, our finance cost is around 370. So which is reducing the basically bridge between the EBITDA and the PBT.
No, sorry, sir. My question is on the tax rate.
Okay, tax rate is around 33%, what we have.
Yeah, so 33 and standalone and 50 and 50 in console.
Yeah, so I'm coming to that. So tax rate on the standalone is around 33%, and we are under the MAT, and MAT is getting utilized during this financial year. Now on the consolidated level, the tax rate is low because we used to create the deferred tax assets on both our implant business and also the Sanar business, which we have stopped, and we want to go conservative. So that is the reason we have not created that deferred tax on these assets.
Okay. And so when are you moving to the new regime? You said the 25% tax rate on the standalone.
So the tax rate, the MAT will be there. MAT adjustment will conclude in the current financial year. So from the next financial year, we are into the next new tax regime.
Okay. So you're guiding similar rates for the subsequent quarters also for the tax rate, given.
On the consolidated level, we're not going to create the deferred tax for these two entities.
Okay. And can I know what is the DTA benefit not recognized till date? Do you have that number?
So I don't have the handy number that I will share with you later on.
Okay, great. So the next question is on the COGS. If I look at the material plus OPEX to the sale, that has gone up to 58% in current quarter vis-a-vis the fourth quarter of FY24. So, but there was a talk in the previous call that they are planning to bring down the COGS. So just wanted to know what is driving this 3% increase in COGS. Is it more a mix change or?
Can you just repeat this? You are talking on the standalone or console level?
Console level, if I add the material consumed plus OpEx, then that stock and trade, change in inventory.
Yes.
If I take that to the sales, it comes to 58%.
So look, if you can see, if you just to give the guidance, if you can see the standalone, there is not much of the deviation on the YOY basis. On the consolidated basis, just to give the breakup of the two things, consolidated include the Sanar business and also the implant business. Sanar cost is in line, or I can say slightly lower compared to our hospital business. So that is around close to 22 to 23%. So the variation is not coming from there. The cost is coming high in this year. Basically, if you can see, there is not any change in terms of the movement of the inventory, which has been there, and we are building up the inventory. So that is going into that, and that is the reason that is impacting some of the cost, which is going out from the implant business.
Okay. And sir, your other income has also gone up to almost 96 million. So can you just give the components? Is there any one-off sitting here?
It is for the couple of things are coming from the Sanar point of view, where we have taken certain kind of one-off discount from the old receivable from old vendors what we have been taken. And there are some rentals and other income and some promotion income is coming, so that has been increased.
Okay. And sir, lastly, the finance cost also going up. So just want to any guidance you can give on that number.
So finance cost is going up. Basically, you can see is on the standalone level. For the Sanar acquisition, we have taken the 100 crores of loan. So that is the reason the finance cost on the standalone entity is going up. On the consolidated level, if you can see in this quarter, the finance cost has gone on YOY basis because, as I mentioned, Sanar finance cost, the lease cost has been included into the cost. And apart from that, as we are building our implant business, where we are building the inventory and lot of working capital requirements are right now is going on. So we have that kind of cost. In the current quarter, we are continue with that kind of finance cost, and from next year onwards, once the implant business will get stabilized, the working capital interest on this implant business will come down.
So any guidance on this number? Will it be flatlined at current levels, or it will come taper down?
It will slightly increase. It will not be the flat line. In the implant, we have to invest more in terms of the working capital for the next couple of quarters.
Okay. Thanks a lot, sir. Thanks for answering the question.
Thank you. The next question is from the line of Saket Saurabh, who's an individual investor. Please go ahead.
Hi, thank you. Am I audible?
Yes.
Yeah. So my first question is, if say within the hospital business, if you say exclude the new acquisition. So what has been our with the Sanar, what has been our blended price hike that we have taken?
Sorry to interrupt, Mr. Saket Saurabh, you're sounding a lot feeble. If you're using the speaker mode,
Yeah.
maybe
Is it better now? Hello.
Much better.
Yeah. So my question is, excluding Sanar in the hospital business, what has been our price hike at the blended level?
Sorry, can you repeat your question?
Yes, so price hike on a blended level.
Price hike for Sanar or for the group?
Not Sanar, excluding Sanar, the hospital business.
So we steadily, kind of look at price revisions, but it's not like, the price revisions for all the areas happen at one go at one point in the year. So, we look at each segment once in a quarter and assess it once in a quarter. And if any revisions are required, then we take them. But approximately, usually this is in the range of between 6 and 8% in a year.
Okay. Where I was coming from is, like arthroplasty, which is our bread and business, the volume is also coming down. So, and if I look at, say, some other businesses also like home care, so is there something that we are trying to do to really enhance the volume growth? Because increasingly, if you look at even the competitors, they are saying that price hike is becoming much more difficult now, right? They given the increasing competition. And so are initiatives really being taken to increase our volume, which seems to be slightly on the lower side? Like, for example, our surgery count increased by 8%, when arthroplasty, which is our bread and butter, showed a negative dip. Even home care business, the patient footfall has come down. So I was just wondering if certain initiatives are being taken to increase the footfall or volumes.
Yeah, so you're right, but I think, the way to look at it is that, the inpatient growth, on a year-on-year basis has grown 15%, and the outpatient count has grown 13%. So, these are high double-digit kind of growth numbers in mid-teens. So yes, of course, we would want to do a lot higher, and the teams are definitely working on increasing the outreach in terms of the different programs that we do. But probably occupancy may not be the only measure by which we should assess the success.
Okay. Therefore, now coming to this FOSO and FOSUM. So now, if I look at currently they are contributing around say 3 crores to the top line, which is say around 1.5% to the overall quarterly run rate. Now, do you really think it is? And on top of that, we have a business like implant, which is really doesn't seem to have operating leverage, at least as of now. Maybe in future it might deliver. So, do you think how are we optimizing our management bandwidth so that we can really look? So basically, are these franchisee businesses really bringing a bang for the buck, because, given the kind of management bandwidth that these might be attracting?
Right. So, in the past, in the last 6 months, there had been a few leadership issues, and, they have been sorted out in the last 2 months. So we have a very senior person who's joined us who's going to overlook the SOC business. Having said that, SOC business, the capital employed is very minimal from the end of the company. And, however, it is a promising business because, we are only trying to build on the orthopedic leadership that we have been able to create, for the last 30 years under the leadership of Dr. Vikram Shah. So, and we will continue to do that, and we feel that this is highly scalable. Of course, from the learnings, of the last 2 years, we believe that franchisee-owned, Shalby operated, that particular model will grow much faster for us than the franchisee-owned, franchisee-operated model. So that is, for the SOC business. And I think from the implant business, Deepak can kind of take it from me.
No, so from an implant perspective, the management bandwidth is pretty well sorted. We have presence now in somebody who drives the US business based out of US. We have someone in Indonesia, and we have an Indian leadership team. So the management of this team, whoever is working on this particular thing, their bandwidth is completely dedicated only to this. So we are on track.
Fair point. Now, so if you look at say the franchisee business, and now that you have said that you have had some learning, now say if you look at say 3 to 5 years down the line, what percentage of top line do you think these FOSO or FOSUM or the combination of these two are they likely to contribute to the hospital business, which is currently say at say 1.5 or something in that range? So within 3 to 5 years, what percentage do you see they would contribute?
So it will still be a very small percentage, because if you think of it, what will happen is that the hospital business will continue to grow like it has grown for the last 7 years. You've seen a 20% CAGR growth. It will continue to grow 20% for the next 6-7 years. So, from the existing levels, you will see that this is growing multifold, right? And then the SOC business is basically much smaller hospitals comparatively. So these are 20, 25, 30 bedded hospitals. So, they cannot individually contribute very significantly to the top line, but it definitely helps you build a great brand equity in that particular city. And we should also consider, the kind of patients that will be referred from those towns into some of our flagship hospitals. So, I think if you look at it from that perspective and a slightly holistic picture, it will create a lot of synergies for the hospitals business also.
Okay. But it's so, when you look at these franchises, it's like more like a hub and spoke model. There is a flagship facility and which caters to capabilities from where are really used to cater to say some of these franchisees in and around that. Is that the model that you are looking at?
No, that will not be the model. They will be completely self-sufficient. But then what happens is, at times when somebody goes to an orthopedic surgeon, for some kind of treatment, and he's a geriatric patient, there might be other comorbidities that, the patient might be suffering from, and, they can always be referred to some of our flagship hospitals.
Okay. So, just one of the last questions. So, the manpower that we have at these facilities, these are all full-time stationed at that place or and owned by Shalby. Is that a fair understanding?
Yeah. So I think we have Mr. Babu Thomas, who I think who's basically the group CHRO, and I think what he also kind of discussed a little bit about Shalby Academy and the kind of programs we run there.
Right. Thank you. Lot of questions. Thanks to touching the HR space. We have overall around 3,155 full-time employees, and also we have around 378 full-time consultants, along with around 900 employees on contractual basis, which contains our entire pool of employees across all verticals. So, which also caters to the subsidiaries and all our main business in India. And US, we have around 100 odd employees in the US stationed at our manufacturing facilities, and a dozen employees in the field in US and other entities like in Kenya and also in Malaysia and a couple of other centers. This is our employee strength. So as far as employees talent development training internally, we have a pool of around 20 trainers across the centers here under one assistant vice president, and we also have a simulation lab established in Ahmedabad to train our clinical team for catering to entire 16 hospitals based out of Ahmedabad and other centers in India. And also the academy division, suggested by Mr. Shanai, we are catering to around 2,000 students are undergoing various programs. And we have partnership with around 6 universities in India. And recently, as a first time of its kind, we got an affiliation to run around 8 courses in our centers in Ahmedabad from Kaushalya, the Skill University. So in terms of HR, we are deploying most of the best practices available in the industry to drive a better retention of employees, attracting good talent, and take this business and support all the business entity to the next level. That's what we are all doing from our side. So a lot of good work happening in academy sessions and other HR and training and development across. Any specific questions out of this, you can go ahead, please.
No, I think I really appreciate a comprehensive response. So just one small question. So how much regarding this franchisee model, so do you have a separate team that looks after this franchisee that you are managing across India?
Yeah, we have a separate team.
Okay. Thanks for patiently answering all the questions. Best of luck for your future quarters. Appreciate it.
Thank you. The next follow-up question is from the line of Raja Kumar Vaidyanathan, who is an individual investor. Please go ahead.
Yeah, sir, thanks for the follow-up. Sir, I'm looking at your slide number 11 of the presentation. Sir, there you've given the ROC, annualized ROC is about 16%. So I just want to know, is there a similar metrics that you if you can give that at a console level also, it will be helpful, sir. And also there is some note that is missing. You are referring to some note 1. I couldn't find what is the note 1.
We will get back to you. We don't have the handy presentation in hand.
Share offline.
So we'll tell you offline.
Yeah. And, sir, if you can also let me know what is the guidance for, for the ROC for the upcoming year? Do you have any number, range, can it be given?
So the hospital ROC will continue to expand from here. And, since the implant business is not yet contributing to the ROCs, it will start contributing to ROCs meaningfully in 3 to 4 years down the line. But yes, you will see that number grow year on year, to get to that level.
Okay. Okay. And sir, lastly, on the regulatory update, so as you all know that the Supreme Court has asked Center to kind of work with the hospitals and standardize all the charges. So just want to know, is there any update on that item?
Update on, no. So the next hearing, I think, is in the next few months. I think it's in September.
Okay. No, you haven't heard anything from the government on that point?
Yeah, the next hearing is in September.
I think it is in August, if I remember.
Sorry, come again? Yeah.
To my knowledge, I remember it's in August. So just wanted to know, are you working with any of the committees with the government,
No.
So any progress made on that one?
We are not working with any committee for this.
Okay. So what is the sensitivity currently we have? Do you think our charges are already kind of we are on par with the market, or we are more on the premiumization range, or just wonder what is the sensitivity of the bottom line if there is any change that is brought in by the government?
See, the first thing is that it is very unlikely that something like this will actually translate into practice, right? So that is point number one. And number two, if you assess the ARPOBs of most of the listed companies, and if you have access to unlisted companies, if you look at the ARPOBs, we are anyway on the lower side compared to most of them, yet generating higher EBITDA margins, right? So I think we will be the least affected amongst most of our peers.
Okay. That's all I wanted to know. Thank you.
Thank you. The next question is from the line of CA Vikash Vijayvargiya from Econtri. Please go ahead.
Yeah, thank you. So one thing I want to understand, this one is one of the announcement in November 23 regarding of the O&M agreement with the Santacruz Mumbai 175 bed hospital. So we already paid the security deposit 37.5 crore. So what is the update regarding this one?
Are you talking about the BCJ hospital in Mumbai?
Yeah, the Santacruz. Yeah, 175.
Yeah. So the trust was responsible for getting the approval from the Security Commissioner's office in Mumbai, and they put in the application in the month of January this year, and they are hopeful and optimistic that we should be able to get the approval in the next couple of months. And after that, we will be taking the required approvals from the BMC and then proceeding with the building and constructing the hospital.
Then it takes another, after everything goes well, then it takes 2 to 3 years time?
Yeah, so I think from the time they are able to hand over the hospital to us, which seems very likely in quarter 2 or quarter 3 of this year, from the point of handover, we think we should be able to deliver the project in 28 to 30 months.
Understood. And one thing also I want to understand regarding this one is there, our occupancy is somewhere less than 50% in the last 22, 23, 24. And it still is a downside. And in the same time, it's my last content. This one is a speaker also asked, this one is there. We are going to be, because our ARPOB is increased from the 38,000 to the 43,000. So this is not an issue for us because whatever your ARPOB is lesser to be comparable in the listed player. But our occupancy is still less than 50%.
See, there are a couple of things I think. One is that I don't think we should assess the success only based on occupancy because, over the years, the average length of stay has been coming down significantly. So, that will affect your occupancy number if patients are getting discharged faster, right? This is one. The second point is that as we keep adding beds, like for example, we added Delhi, right? Now, when we add Delhi, you will be seeing that, we've added the number of, we've increased the bed capacity, right? And at the same time, the operational beds over there are much lower and, the occupancy there is much lower. So you will see that, because of these additions, there will be a kind of slight dip in the overall occupancy percentage level, right? But if you look at the overall growth, the way I would look at it is that, the inpatients have grown, inpatient count has grown by 15%, the outpatient count has grown by nearly 15%, in which I think is a very healthy growth, along with a average 4 to 5% ARPOB growth, which is giving you a near 20% kind of top line growth.
The surgery count is already increased, sir. Because it is 7,700 total right now, so almost is a 9,000. Surgery count is drastically changed in the quarter to quarter. Only that means because whatever the self-pay patient is a 35% in our cases. So 65% is the government and the insurance patient is there. That means a slightly increase on prices is there, as per my understanding, sir.
Sorry, what's your question? I'm not able to get it.
No, not an issue, sir. Okay, thank you.
Thank you. The next question is from the line of Kashish Thakur from Elara Securities. Please go ahead.
Thank you for the opportunity, sir. Mostly, all of my questions have been answered. Just one question. What has been our percentage of international revenue from the international patients, excluding Sanar?
So for this quarter, it's around 2 crore.
So this is excluding Sanar, right, sir?
Excluding Sanar.
And including it?
It's around
15 crore.
15 crore.
Understood, sir. Thank you so much.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Thank you everybody for joining the call. We will connect again into the next quarter. Apart from that, if you have any questions, you can reach out to investor email ID. Thank you.
Thank you. On behalf of Elara Securities Private Limited, that concludes the conference call. Thank you for joining us, and you may now disconnect your lines.